Okay guys, welcome. I'm doing the AQA Accounting ACCN2 June 2012 paper. I'm doing question 2, which is a cash flow forecast / cash budget, whatever you want to call it, and question 3, which asks you to adjust profit, asset measurement and accounting concepts due to some mistakes previously made. So question 2, we're given our additional information, just like an income statement and balance sheet, and then we have to transfer all this information plus this bit here into a cash budget. So point 1 is just giving us the data which we're going to use in points 2, 3 and 4. So let's just start off with point 2 then. So point 2, all sales are on credit, so straight away we know that whatever we sell in September we're not going to receive in September, for example. Okay. Also, the cash budget is for September to November. So 3 months. Okay, all sales are on credit. 80% of customers will pay in the month after sale. So we're going to have a 1 month credit period. The remaining customers are expected to pay 2 months after sale, so that's 20% of customers. However, 2% of these customers are unlikely to pay, so Chun has decided that these amounts due will need to be treated as bad debts. Bad debts do affect income because we expect to get money from these consumers, but we haven't. So first month we are doing is September, so I'm just going to abbreviate all the months so it makes it a lot easier for me. And we're going to do 1 month. So 80% of customers will pay in the month after sale. So 1 month back, August, 24,000, and it's 80% of these customers, so 0.8, and that gives us 19,200, I believe. Yeah. Okay, so 2 months, because 20% of customers will pay 2 months after sale. So I'm going to count 2 months back from September. 1, 2 to July, 20,000. Now, however, 2% of these customers are unlikely to pay. So first of all, what we need to do is times by 0.2 to give us 4,000. So it's 20% of the original value, and then it's 2% of these will not pay. So we're going to have to times by 0.98, which is just 1 minus 0.02, or 1 minus 2%, whatever you prefer. And that's going to bring us to 3,920. Okay, 20,000 times by 0.2 and times by 0.98 is not the same as timesing 20,000 by 0.18. It's 2% of the 20%, which is that 2% gap is a lot smaller than the difference between 0.2 and 0.18. So just read the question carefully and you'll get past that quite easily. So October, exactly the same method. 1 month, count 1 month back to September, 18,000 times by 0.8, bringing us to 14,400. 2 months is going to be 2 months back, 1, 2, August, 24,000 times by 0.2 times by 0.98. That's the same as what I'm doing there. I'm just doing the sum. I'm just doing the sum of them two, and then timesing by 0.98. So it's exactly the same thing. Don't worry. 4704. November, 1 month. 2 months. Exactly the same. November. Count back 1 month to October, which is 16,000. Times that by 0.8 gives us 12,800, and 2 months back from November is September, 18,000 times by 0.2 times by 0.98, and that's going to bring us 3,528. I'm sorry I'm not using a calculator to calculate all these, but I'll be sat here all day doing the calculation for every single one of these and every other point. So it's just easier for me just to have the answers in front of me and being able to explain why they are that. Not show you how I can show you how they're done, but not show you showing me doing it, just explaining it to you. So point 3, purchase of goods for resale will be paid in the month after the purchase. So this is just the same as the 1 month credit for a sale. So I'll show you an example. So September equals, so it's the month before we're going to pay. So purchases, so September to August, purchases 11,500. On to October, just going to count them back to September, 10,750. We're giving 1 month credit from our suppliers when we're purchasing goods. That's basically what this question is. So November back to October, 9,865. Okay, that's quite easy. Okay, the easiest point of them all, point 4. Overheads will be paid in the month they are incurred. That just means if we are charged £1,000 for something in September, we pay for it in September. That's basically it. So, easy enough. September equals its own overheads, 5,489. October, exactly the same. October, its own overhead, 4,982. And then November is 4,126. Easy. Point 5, right, I've done some highlighting on this because this is a bit, not tricky, but make sure you read it in detail. Chun will take drawings equal to 10% of the sales in that month. It's the sales for that month. So for September we're going to use 18,000. We're not going to use the income for that month, the inflow for that month. It's just the sales. Whether they have 1 month credit or 2 month credit, doesn't matter. It's just the sales for that month. So Chun will take drawings equal to 10% of the sales in that month. However, his drawings will never be less than 1,750. So for example, say if he sold nothing in December, he would still take drawings of 1,750 no matter what. That's what that question is saying to you. So September equals, right, sales for September, 18,000. He's going to take 10% of that, 1,800. Is that above 1,750? That's right, so we're going to use that. October. Okay, sales for that month was 16,000. Times by 10% gives us 1,600. Is that above 1,750? It's not. So that just gets replaced with 1,750. So now we're going to use that instead. November. Sales for that month for 20,000. So you can probably tell that we're not going to need to bring it up to 1,750 because it's 2,000, which is above 1,750. Right, point number 6. He has asked the bank for a loan of 24,000 to repay the business overdraft. So now we know his opening balance is going to be a negative straight from that. The loan will be received on the 30th of September. So loan received, so in brackets inflow, so it's going to go to the top of our cash budget in September, equals 24,000. Easy enough. But now we have to repay the loan. We have to pay interest on the loan, as you do with every loan in the world, really. The loan will be received on the 30th of September and will be repaid in 24 equal monthly instalments commencing on the 31st of October. So, loan repayments, September, October, November. Well, as you can see, it's repaid in 24 equal monthly instalments, but commencing on the 31st of October. So we're going to pay nothing in September. Okay, so it's paid in 24 equal monthly instalments. So the amount of the loan is 24,000. So we've got to repay that principal amount back over the number of months, 1,000. So we're going to pay back 1,000 per month for 24 months, so 2 years. So we're going to pay the exact same back in November. Interest at 6% per annum will also be paid monthly. The interest will be calculated on the amount of the loan outstanding at the beginning of the month. Okay, so loan interest. Okay, so September, October, November. Okay, point to bring out from this additional information is the beginning of the month. So it's interest can be charged on the amount of the loan outstanding at the beginning of the month. Well, at the beginning of September, we didn't even have a loan. We received it on the 30th of September. So how can you charge us interest for a loan we never had? So that's obviously going to be zero. We don't have it. I haven't even started paying it back yet. So, however, we started repaying it in October. And at the start of October, we still owe 24,000. So we have 24,000 times by the interest per annum, 0.02. Per annum means per year, annual, 12 months, that's what it means, if you didn't know. And then it'll be paid monthly, so that's over 12, 120 I believe. Yeah. What some people did was they did 24,000 times 0.06 and didn't divide by 12, so they got an interest of over 1,000. It's just thinking, well, if they're paying an extra 1,000 a month in interest, that's ridiculous, because they're paying 1,000 back per month already, and over 1,000 interest per month as well. That means they're going to be paying double the amount of the loan back. It's just ridiculous. So sometimes just think about it in a context point of view. Don't look at the numbers and think, oh, that looks right, it's fine. Think about it. Think about how much they actually would pay. Would you take out a loan where you paid double the amount you borrowed? Because I know I wouldn't. So 23,000 now, because we've paid back a month. We've paid back 1,000. It's the interest calculated on the amount of the loan outstanding. Amount of the loan outstanding. We've paid 1,000, so 23,000. Once again, times by 0.06. It's divided by 12 again, which is 115. Can be a bit tricky, but if you just think of it step by step, it can be quite basic. That's with all accounting, A level, university. It's all step by step. As long as you take it one step at a time, you'll be fine. Sean intends to purchase a non-current asset, so it's an outflow of 6,800 in September. He estimates the depreciation on these will be £100 per month. Okay, so NCA purchase, so it's a purchase, so it's an outflow. So let me move that up so you can all see that. It's going to give us some 6,800. Okay, depreciation. What do we know about depreciation? Well, it goes in the income statement, but it's not a cash expense. It doesn't cost the company anything. It doesn't. When we have a car for a year, just because it's gone down in value by £5,000 does not mean our bank account goes down by £5,000. We're just decreasing the value of the asset in line with the accounting concept of prudence, etc., etc. So what we can do is just cross that out. We're doing a cash budget. We're only interested in cash. We don't care about profit. So we don't need depreciation because it doesn't deal with cash, does it? And point A, he estimates that the bank balance at the 1st September will be 23,680 overdrawn. So we already knew it was overdrawn, but now we know the exact value. So I'm going to put it in brackets to show it's a negative. And that's it. Basically with cash budgets, as long as you get the workings, it's just what I call plug and chug. You just put it in. You just put all the numbers in. There's nothing else you need to put in. All you need to do is work out your net cash flow, add it to your opening balance, get your closing balance. Closing balance becomes next month's opening balance. Really basic stuff. It's not like an income statement where you have to still remember to do a few things, add a few things you haven't dealt with. You've dealt with absolutely everything in here. So we can actually take the question paper away now because we don't actually need it. And I've actually took the liberty of printing off the actual answer sheet, and I've already done the layout simply because it would just take me a while. Like with the calculations, it just saves me time. You don't have to watch the videos long and I can get more explanation in. So September, 1 month's credit. September, 1 month's credit, 19,200. And you know what, we'll go down it column by column. I know some people like to do row, 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 add up the rows, but I don't do it like that. 2 months September, 3,920. Loan, right, when did we receive the loan? Point number 6, loan received inflow in September, 24,000, so we received it in September. So it's just going to go there. and that's going to give us 47,120. That's the total inflow for September. Okay, so purchases. Purchases were point number 4, I believe. Yeah, September 54. Oh no, sorry, that's wrong. Point 3. My apologies. September 11,500. Overheads were 0.4, that's right, 5489. In the month they are incurred. Drawings were 0.5, I want to say, yeah. 1800, it's above 1750, so we can put that in. Loan repayment, loan interest. It's better to put 0 in just to show you know what you're doing. We haven't even got the loan yet, so how can we start repaying it if we haven't got it? And the NCA purchase we did. NCA purchase outflow, and I'll bring the question paper back actually. Chun intends to purchase a non-current fixed asset in September. So there you go. So that's going to be 6,800, giving us a total outflow of 25,589. Okay, opening balance. What's our opening balance? Well, it was given to us in point 8. We're overdrawn. 23,680. I'm not going to be doing part B actually, because I don't think doing written questions on YouTube is quite the best. I'm just going to be reading the mark script. I'm just going to be reading the main points you need to, which you can bullet point yourself in 2 seconds if you read the mark scheme. So it's just best to go through the questions where there's method and numbers, so I can explain the ideas and the thinking behind them. So the net cash flow, 47,120 minus 25,589 is 21,531, giving us a closing balance still in overdraft, 2149. So that's the 31st of September, which becomes our opening balance in October. So closing becomes opening, like carried down becomes brought down in our T accounts. We have a new opening balance. So now this is exactly the same September, we're just putting our numbers in. So October, first month, 1 month, sorry, 14400, 2 month is 4704, and we only got 1 loan that was given to us in September. No loan. So we've only got an income now of 19,104. So you can imagine that 24,000's had a big deal to do with the net cash flow. Because if we didn't have that, we'd actually have a negative net cash flow. So there's a good chance we have a negative net cash flow here. So purchases is 0.3, 10,750. Overheads were 4,982. Right, drawings. 10% at 1,600, because that's the sales in October, was less than 1,750, so we just used 1,750. That is Chun's rule. Loan repayment, we repay 1,000 each month, and the loan interest I calculated as 120. And we didn't purchase anything in terms of non-current assets. And our total for that will come to 18,602. So our net cash flow for this one is actually still positive, 502, and it leads us to another overdraft of 1647, becoming a new opening balance of 1647 for November. 1 minute. God, I'm talking too much. Hurt my throat. Okay. November first month, 1 month, sorry again, 12,800. November 2 months credit, 3,528. Didn't receive a loan yet again, 0. Income is coming to 16,328. What you can see here is our inflow is actually decreasing, which could be a tip for your part 2. Purchases. Okay, 0.3, 9865. Overheads were 4126, the month they occurred. Drawings were fine for this one, they were 2000, so we don't need to use the 1750 like we did in October. Loan repayment was 1000 again. However, because we've already paid back 1000, the interest is going to be a little bit less at 115, leaving us to a total outflow which outweighs our inflows of 17106. We make a loss at 778 in cash terms for November, leading us to a final closing balance of 2425 for your cash budget. Okay, that's it. If you got that, well done. If you didn't, I hope this helped you get to it. But now I'm going to move on to question 3, which I think is a very good question, in all honesty. It tests a lot of things. So, where is it? Let's work by it one point at a time. So, Laura owns a number of shoe shops. She has prepared a draft income statement, trading and profit and loss account for the year ended 31st of April 2012 and the draft balance sheet at that date. The draft income statement showing the net profit for the year to be 68,745, which it shows here. The draft balance sheet shows net current assets of 5489. One word to note: current. That's a very important word in this, especially when it comes to point 5. 5489 as it gives here. Laura is unsure of the correct treatment of the following, so okay. Point 1. Laura receives some shoes costing $250 from a new supplier on a sale or return basis. The shoes have not yet been sold and have been included in the cost at cost price. So we've received some shoes, we haven't sold them. Or returns, we haven't sold them, so we're going to return them. So our closing inventory did include these, so we're going to have to take these out of our closing inventory. So our closing inventory is going to decrease. So say if we had £1,000 inventory which included the 250, we have to take the 250 out because we're returning the shoes, we don't have the stock anymore, so that's going to go down. We take away our closing inventory from cost of sales, so COS, cost of sales, so our cost of sales are actually going to go up. And what are cost of sales taken away from? Cost of sales are taken away from revenue to give our profit, so our profit is going to go down. So I hope you understand that. Closing inventory has gone down because we've lost some of our inventory, so the cost of sales are going to go up because we take that away from our open inventory and our purchases, so that's going to become bigger. And because that's bigger, with the same amount of revenue, profit's going to go down. Okay. Also, because our closing inventory goes down, our current assets account in our balance sheet is also going to go down. So what we can do here now is point 1, we've proven that that's gone down by 250, that's gone down by 250. Realization, that's right. So point 2. I think it's just good to prove that, because some people didn't really understand that as they put on the student room. They were glad that they didn't have to calculate point 1 because they didn't really understand it in a way. So Laura paid for her own health club membership amounting to $375 with a business check. This has been charged to sundry expenses. Well, she's put it in sundry expenses, but it shouldn't be there. So we've overinflated our sundry expenses. So they're too high. So we're going to have to bring them down by $375. And what's that mean? Our sundry expenses have gone down, so our expenses overall, our cash outflows are overall down. So we're taking less expenses away from our gross profit. That means our profit must be higher. So what we're actually going to do is add 375 to our profit. I think that's that for that one, yeah. It doesn't affect assets, that. No, it doesn't. Okay. However, what is the business? I've just given that away. What's the accounting concept? It's business entity. There's a difference between the owner's accounts and the accounts of the business. So if the owner wants to buy a new house, they use their accounts. They shouldn't mix them with the business bank accounts. Okay, point number 3. Shoes costing £4,000 have been included in the closing inventory valuation. The shoes would normally sell for £6,000, however they are shop soiled and damaged and will need to be repaired before they can be sold. It is expected that the repairs will be £825 and then they can be sold for £4,500. Well, this concerns IAS 2. You may not have run into this, you may have them. That basically means inventory is valued at the lower of cost or net realizable value. This also follows the prudence concept. We should be pessimistic about things, negative about things. We shouldn't be too over whatever about something. We shouldn't be predicting too high for our assets. We should be putting them a bit lower, like a sort of a lower worst case scenario, but not too bad. So cost. So we're going to value it at the lower of cost or net realizable value because we're a prudent business. So the cost, shoes costing £4,000, was given to us in the first 3 words. So cost is 4,000. What's net realizable value though? Well, net realizable value is your selling price minus any repairs, advertising, etc. that you will need to sell the stock. So our selling price is 6,000. Oh, it's not. Sorry, it's 4,500. It's what it can be sold for. After all the repairs, what we can sell them for. So 4,500 minus the repairs, 825, brings us to 3,675 for point 3. Okay, so what I'm going to highlight now is 4,3,675. What's the difference between these? 4,000 minus 3,675 equals 325. Okay, what's that mean? Well, they're originally valued at this, originally valued at 4,000. Now they've been lowered in value, 325. So what's that mean? Well, the value of our closing inventory has gone down. So it's just the same as point 1. Closing inventory has gone down, cost sales has gone up, profit goes down. So it's just profits going down 325 again. And it's the same case with our assets. Closing inventory has gone down because we've valued our inventory lower, so our current assets must also go down. And the concept for this, as I've previously mentioned, is prudence. Okay, point 4. Laura rents out a shop. Rent receivable 14,000 has been included in the draft income statement. This includes 2,000 which was for the year ending 31st of April 2013. So the 31st of April 2013 is just a year after this year. So that's where we are now basically. And that's in 1 year's time. So point 4. It's rent receivable. So someone's paid it to us in advance. What's that? That's a prepaid income. Okay, right, well, what have we done? We thought 14,000 came into the business this year. It's actually only 12,000 because what it is rent receivable. It's 14,000 minus 2,000, which gives us 12,000. So rent receivable, what do we do with any other income? We add it to our gross profit. Like say if we sold a non-current asset for a profit, we add it to our gross profit. So that will be added to our gross profit. Well, originally that was added to our gross profit, and now it's that £2,000 less. So what's actually going to happen is our profit's going to go down. by 2,000 because someone prepaid, so £2,000 less. However, right, now onto the asset part. Right, so think about it. If we have a prepaid, a standard prepayment means a prepaid expense. That's an asset. And a standard accrual, so an accrued expense, is a liability. And with income, it's the opposite way round. So a prepaid income, someone that's paid us early, is actually a liability. So an accrued income is actually an asset. So think about it. Say if you rent out your shop and you meant to get £5,000 this year, but you haven't received it. Someone owes you £5,000. It's just like a trade receivable, so it's going to be an asset for that. So the prepaid income, someone's paid us £2,000 early, so our liabilities are going to go up. So liabilities count against our assets. So it's going to be £2,000 less on net current assets, because liabilities count against our assets. And what is this accounting concept? Well, it's accruals, as I've just explained. It's matching up your year to matching up your expenses and incomes to your financial year, making the links. So what we've done here, we've tried to link up 14,000 minus 2,000 to our financial year. The 2,000 there is linked to this financial year, and 12,000 is linked to 12,000, which was 14,000 minus 2,000, is linked to that. So there you go. Okay, point 5. On the 4th of April 2012, so this financial year, new fixtures and fittings were purchased at a cost of 3,000. The fixtures and fittings were bought on 12 months interest-free credit, so it's going to be a current liability because it's paid within the next 12 months, which is what a current liability is. It is law's policy to charge a full year's depreciation in the year of acquisition. Depreciation provided at a 33.3%. Yeah, that's right. Using the reducing balance method, no entries are made for this transaction. So now, how do we work this out? Well, why don't we work out the depreciation first, because that's going to affect our profit, and nothing else there is going to affect our profit, because it's all to do with the balance sheet, purchasing assets, us owing people money. That's assets and liabilities. So let's leave that out. Let's get the profit bit worked out first. So the depreciation is the only thing that's going to affect it is depreciation. So in the year of acquisition, we've only had it less than a month, but we're still going to charge a full year to it, is what it says. So 3,000. We're going to charge 33.3 recurring depreciation. So that's just the same as dividing by 3. So that's the £1,000 is the depreciation for this year. And we haven't included it in our profit so far, and depreciation is taken away from our profit. So once again, our expenses are going to go up, and more expenses being taken away from our gross profit means our normal profit, our net profit, is going to go down. So in 5.5 we're actually going to lose £1,000 of profit. Right, now point 2. The simple thing to say is the fixtures and fittings were bought on 12 months interest-free credit. So instantly we have a trade creditor, a current liability, CL, of £3,000. So instantly you think net current assets are down 3,000, and then you think, oh, but we've purchased an asset. However, this asset is a non-current asset. It's not a net current asset. It's not a current asset, it's a non-current asset, sorry. So it's not going to be included in our net current assets, it's going to be just this. So it's just going to be down 3,000. And now, what would I say this is? Personally, I would say this is consistency. As you're paying depreciation, you're charging depreciation every year to your asset. However, what they also accepted for this answer was accruals. Understandable, really. And prudence, definitely I'd accept prudence, because you're charging a year's depreciation in the first year. But that's that. Point 6, the final one. Law has not included any entries for the provision of doubtful debts in the draft financial statements. The provision for doubtful debts at the 1st of May was 1,250, and then a year later it was 1,050. Okay, well, last year it was 1,250. However, this year, when I say this year, I mean the 30th of April 2012, it was 1,050. Well, it's gone down, and when it goes down, that's an income. A decrease in a provision for doubtful debts is an income, so our profit is going to go up because we have an increased income, and it increases by the difference between this year and last year's provision. So 1,250 minus 1,050 is just 200, so our profit is going to increase because our provision has decreased. However, we still need to deal with the assets. Okay, so she hasn't included any of this information here in her calculation of statements. So what we can assume is, now we can ignore this. We only care about current assets now. The provision at the 30th of April 2012 was 1,050. But what do we know of a provision for doubtful debts is? We decrease the whole trade receivables. We take away all of the 150 away from our trade receivables. So our trade receivables are going to go down because she hasn't included it. So that means our assets are also going to go down because our trade receivables are a current asset. So we're going to take away 1,050. Now, personally, I say this is prudence. Because you're being prudent, you're assuming that some people will not be able to repay it because they'll go insolvent. That's what provision for doubtful debts is, which I think is probably the right answer. But also they accepted accruals, and they accepted consistency as well. Consistency does make sense because you're going to do it every year, and you're going to be repetitive and methodical with calculating it. So you could have put accruals for all of the last three here and got the marks, basically. Anyway, the total final answer is 65745, and it's going to be a negative 1136. We have more current liabilities than current assets, that shows. And that's it, really. If you need any help, please email me. The email's always in the description. If you've got any papers to recommend, please, if you find me helpful, recommend me to a friend, because I'll probably be able to help them as well. Anyway, I'll see you later, and good luck with your accounting.